Welcome everyone to this week's edition of the Commercial Real Estate 101 Meetup Group. For those of you guys who are tuning in for the first time, we've been doing this meetup for almost 2 years now. It's kind of started in response to the COVID-19 pandemic and, everyone going virtual. And so, we figured why not just bring people together to learn more about commercial real estate topics from all across the country. And it's given us the opportunity to connect with great people like Ron. Ron is an attorney in Dallas, and he does a variety of different commercial real estate functions, both on the leasing end. He's worked with syndications as well, and that's going to be kind of the topic of discussion today. So, Ron, welcome, and we're excited to have you here.
Hey, thank you. Happy to be here,
dude. Of course. And if I'm not mistaken, and correct me if I'm wrong, Chad is actually on the call right now. Chad Griffith, and I believe you were on his call it meetup, or I should say podcast as well. So you guys have connected in the past. So
yeah, good to see you, Chad.
That's awesome. Well, yeah, and it's kind of cool being able to do like these different podcasts and content creators and such, because you get to just connect with so many different people, and it's kind of a small community the commercial real estate industry is. So I'm excited to learn a little bit more about your backstory, and then also get into the topic of commercial real estate syndication. So what we typically do when we first meet the individual is we like to learn a little bit more about the person. So if you don't mind sharing a little bit of your backstory, I think that'd be helpful.
Yeah. So I'm originally from Texas. I grew up here. Parents have always been involved in commercial real estate and other types of real estate investing. They've had their own businesses in the North Texas area. But went to school at Cornell, up to New York, worked for a little bit, law school in Miami, took the Florida bar, still pretty active in Florida. I worked there and doing real estate work. And then I came back to Dallas because I always knew that I wanted to come raise a family here. And, to me, it was always very natural to start picking up like SFR. I think I had a couple partners, my brother and I had one. But we're basically picking up one or two a year and just collecting the rent. And it's great. That's how I grew up. But fast forward to 2017, 2018 or so, I was getting married, buying a house, and we have a kid on the way. I sold everything. So at that point, I had six doors. Even with property management, it just gets too much, right? Decision-making, renewals and appliances and roofs. So I sold everything, which I thought was a good price in Texas at the time. Probably still doubled since I sold those, but put everything into industrial. And so, I did a very broad survey, given that I'm a real estate professional. I had advised clients on office purchases and multifamily and retail and car washes, self-storage. I had seen clients and I'd helped them do it all. And I really liked industrial, even at the time, which it wasn't quite in its darling phase, but these guys had the best tenants. They never bothered them. They never bothered me. And so that's what I wanted. I wanted something with a longer lease term. I wanted to deploy more capital per investment, per underwriting. Because again, I wasn't going to be one of these guys that can look at 10 deals a day. I just wanted to say, hey, let me look at 5 deals, 6, 7, 8, pick one, put my money in, and then I don't have to invest for another 12 months, another 18 months. So that's how I settled on industrial. Currently, with myself and a couple other guys, we have about 100,000 square feet of triple net. They're mostly single tenant net lease buildings. Great tenants like, I don't know, they're a few billion in revenue. They're not publicly traded, but I guess they're credit, like regional credit tenants. I don't know how you describe them. They have audited financials, which impresses me. So they're great. And everybody's paying, everybody's taking their rent bumps and taking everything in stride. And I buy, in addition to my law practice, which I manage here. We've grown, thanks to YouTube, I guess. Have a little shop with attorneys and a couple full-time staff and myself. And so I invest in industrial as well. I think Chad does that too. And I don't know, Raphael, you have your own deals too, right?
Is that on your end or
¿Cómo
my
está,
end?
Sergio?
I think that's Veronica.
Oh, okay. Sorry. I'll
Yep.
mute that. Sorry.
No worries.
Yeah, go ahead.
Because Raphael, you put your money in your deals, right? I think.
Well, yeah. So I own a fourplex myself. I started off house hacking. So I actually come from a tech background. So I was a software implementation consultant for a while, and then I transitioned into commercial real estate. Before doing that, I was house hacking, and that's what enabled me to transition. And so we're working towards trying to get, commercial deals, primarily in the retail and industrial sector. That's just kind of what our brokerage does a lot of. So that's kind of the I guess the ecosystem that I feel most comfortable in. And so,
Absolutely.
but yeah, at this point in time, I don't personally have on the commercial end as of yet, but that's the ultimate goal, is to get that way.
So, but you're on the path, and
Yeah.
if you own something, to me, there's just a huge gulf between the people who are planning and analyzing and they're always scared about the market, and they're like, oh, am I buying too high? Oh, should I buy this industrial at 6 cap? Should I buy this multifamily at a 5 cap? I'm like, holy cap. Looking backwards, you should have bought that at a 5 cap because it's trading at a 3.75 now. It's crazy.
Absolutely.
And
yeah,
so
it's the time horizon. Like if you're going to hold it for as long as you want to hold it, right? For hopefully in perpetuity. I mean, even if you buy quote unquote at the top of the market right now, if you hold it for 30 years, I mean, the ultimate value is going to be there. So
for sure. So that's, I think we're a secondary subset of commercial real estate professionals is, people that also want to put their money into deals. I love to share this advice. I got advice from this, 40-year practicing attorney. The guy grew up and was raised, I don't know if he lived in the same house in Plano, which is a suburb of North Texas. And we're up opposite on a case, and he just really liked me and said, hey, you're a good guy. Like, come by, let's have lunch. So we closed the deal and we had lunch, and he was just telling me, he's like, oh, do you invest? And I said, yeah, in residential. I was just picking up these little, like in Texas, we have a lot of like 250 houses, 200, 250K underneath. And I was like, I have a couple of these. I'm picking them up. He's like, oh, you got to put money in a big deal. And he said, him and a partner a long time ago, we see so many deals come across our desk, right? Dozens, I don't know about hundreds, maybe you see more than us, but you see so many, and some of them are thin and some of them are okay. But eventually, sometimes they're home runs. And those are the deals you got to put your money in, because we can earn a living and we can be quote unquote rich. You can make a good living. You can pay for your kids. You can pay for your house, all that stuff. But if you want to be really rich and like actually have some money, you got to have some equity. You got to put your skin in. And we're in a unique position that we see so many deals. And for me, I represent clients when they buy and when they sell. So I guess same for you, but like, man, I see that delta. I know exactly how much equity my one client relationship has and how we put that in. And then I know how much he's getting on the back end because I see his operating agreement. Just like, geez, this is what you got to do. And just place a couple of calculated bets. The story for him was like, he bought, I don't know, like 118 or 150 unit apartment, him and a partner, just cash flow, blah, 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 sat on it. People were just offering him, 8 million. Oh, okay, great. And we don't want to sell. We like the cash flow. 12 million. Oh, okay, that's pretty good. That's a good chunk of money, but split 2 ways, blah. And then he's like, somebody offered $16 million. And this was even, pre crazy boom, but they were like, we just have to take it. This is, I don't say it's life-changing, but for them, it was just so much free money that they could just relax. So they did sell it in North Texas. And that's the story that I want to emulate or have that flexibility of, you got to be an owner. You've got to have this, I don't like passive cash flow. I don't think anything's really passive. It's you either put the money in, you put the work in up front and then you put the money in later, or you have a constant balance of money and time, like our business. But there's no such thing as passive cash flow. So anyway, but you can create income producing assets that are, a return on your initial capital. So if you want those types of assets that will still generate a lower return with a very little of your time, with less of your time, then that's what you got to do. So that's my very long backstory. I'm coming at it from a legal perspective. I do think that in our profession, it's a little bit more unique to have lawyers who are traditionally more conservative, and they're all buttoned up, and they wear suits all the time, and I don't do a tie. But to find lawyers that put money into deals, I'm willing to risk it. And it's very different than a lot of my colleagues, because I tell my people, like, hey, you should put some money in this deal. Let's just put 100 grand, put a 200 grand, whatever. You might lose it, but you're not going to lose all of it. Maybe you lose half.
Yeah.
Or maybe you make no return. Honestly, I really think the worst case scenario for us is just no return. Like, just get your principal back. And they say no. They're like, I don't want a risk of upside versus no loss. I'm just going to just put it in the stock market. I'm like, look at the market. It's exactly back to 1 year ago, a year and a half ago.
Yeah.
And it just kills me. All that time is quote wasted.
Oh, absolutely. And I think not only for the perspective of, owning real estate, but that also makes you better in your business, because now you're an owner. So you can advise someone from this perspective of an owner. And I can't tell you how many times I've interacted with clients, and I tell them, okay, well, in my situation, and again, I don't have a huge portfolio as of yet, but I could say, well, in my property, this is what I do. This is how I handle this particular situation. And that makes a huge night and day difference, and how people respect you and people interact with you. And, pertaining to your experiences, obviously on the commercial side, there's a lot of people on this call that are, aspiring to get into the investment side as far as commercial real estate is concerned. And, some people may have the dry powder to execute, but then there's others that don't. And that's kind of where, I think this potential, topic of syndication could be of value. And so really, could you give us like a high level overview maybe of what a syndication is? I think that would kind of give us some context. And then from there, if you could break down, typically the responsibilities. I know there's obviously general GPs and then LPs. And if you can give a high level overview of each of those, I think that'd be great.
Yeah. I've kind of done a couple of talks, on this broader topic of just how to raise money. Because there's a couple different ways to skin that cat and collect the equity to close a deal. So I'll kind of go through that. And then obviously a big part of that topic is the common Reg D 506 offerings, which are the bread and butter of most real estate raises. So I think the easiest way would just be assume, it's a single owner, single member LLC. You're putting up your own money as equity. That's savings from a checking account. So let's say you buy $1 million property, you put 200,000 down, it's your property. That's the easiest way. And what happens though, let's start with that example, because of that 200,000, now we can start to slice it up, and we start to say, how do we raise the 200,000 of equity needed to close this deal? So I think in terms of complexity and difficulty and I don't know, risk, but certainly cost, it would be the next step of just a partner. And very easily, I reach out to Raphael and I say, hey, I've got this deal. It's $1 million purchase price. I got loan. I got financing for 80% LTV. We need 200,000, ignoring closing costs, but 200,000 to close it. I'll put in 100 and you put in 100. We will be partners in an LLC that takes title via the SPE, special purpose entity, but we're both equal members, call it 50-50 for the sake of that. We split everything. The duties are 50-50. We both personally guarantee the loan. We're both responsible for kind of operating. That is the easiest and simplest way for somebody on this call to say, hey, I don't have $200,000 or 20 million or 2 million, whatever your number, but I have one other partner and we can do it together. And so I say that because that is a very common way that you can spread the risk. You can, reduce your own capital needs and, even step it up. So like in my examples, we can have 3 guys. So it's a lot often kind of what we have on our deals is we're buying stuff in the call it 3 million, 2 to 6 million price range. So the equity is like $1 million. So we'll just say, hey, you guys write a check, 300K, boom, boom, boom. And that's literally how we do it. Granted, I'm a lawyer and we're very comfortable with the operating agreement. And there's a high level of trust because we've done so many deals together, but that can be done. And you can take down a fairly significant portfolio across these people doing what I classify like a JV, direct, joint venture, partnership agreement, direct in the LLC. And banks have no problem with that. If you're getting regional lending, private banks, they're fully comfortable, and you can have other investors. You might have 4 or 5 people. There's kind of a limit on complexity on the maximum number of people you want, but some of the new platforms, and this is total aside, but like Arrived, I don't know if you've seen that one, that's Bezos backed. It's like fractional residential ownership, but non-security raised, not accredited investor. You can put $100 in and you become a member of the LLC that owns the dirt. So it's kind of interesting in how they manage that. I think there's a lot of issues, but theoretically they have like 1,000 people. They have 500 people owning a share of this LLC that owns these houses. They're residential. So that's the next level. And again, in terms of incremental difficulty, complexity, and cost, single owner, I put up all the equity in that's the lowest. Next is you add 1 partner, you add 2 partners. That's the next level. And then I would say the next level after that is what we commonly call syndication. Doing the GP sponsor limited partnership, which becomes a legal term, right? We're jumping into, no longer can you use words kind of interchangeably like partner or member or managing member. Now we're getting into some legal terms of art, which is the process of let me back up a little bit. So if you wanted to sponsor the deal, again, that $1 million commercial property, and you need to raise 200,000, you say, hey, the problem is, Raphael, I only have 50. I'm going to raise 150K, but I want to assure my investors that they are limited partners. They have limited liability. They don't have management rights, and they don't have legal liability as the sponsor of the deal or as the general partner. And so what you're doing though is essentially you're selling a security. And I don't need to go too far into the SEC side of things, but essentially you're selling a security which is regulated, which quote requires registration with the government or with the SEC, because you're selling a financial product at this point. You're promising a return. You're promising a return of capital and profit based on the efforts of others. So I'm getting a little bit too legal, but that's like the Howey test, and there's the Orange Farm and all that test and case law. But suffice to say, you kind of have to take it for face value. If the people are not active members in the group and making decisions on leasing and lending and repairs and that sort of thing, they're limited partners and they're not active, and their liability is limited. Their role and their tax treatment is a little bit different. But you're selling a security. So in order to sell a security, you normally have to register that security with SEC, go through a full-blown registration process, very expensive, audited financials, all sorts of affidavits, statements, controls, GAAP accounting, big deal. So you have the Reg D, which is an exception. And Raphael, let me know if this is too much in the weeds. Like, do you want me to just skip to the good part?
No, I think this is very, very important to understand at least the implications of it, because you're right. You're selling a security, unlike in a partnership where you guys are all taking the risk together. So you guys have equal, your responsibilities may be different based on what the operating agreement says, but the risk you take legally and financially is the same. Whereas in a syndication structure, the GP is typically the one who's going to be, guaranteeing the note. The limited partners have limited responsibility or liability as far as the note's concerned, but it's just a completely different. It's governed by a completely different, legal structure.
That's right. That's right. So. Yeah, and so I think it is important to convey, at least in the sense, so that people understand what the risk is, because when deals go sideways, and I've seen sideways be very, very low, like. Sideways is like just not hitting your 2.1 EM, an equity multiple. You just hit a 2.0 and some investors that you don't really know is super pissed off, they're going to sue you. They're going to say, I want my 2.1. I can't believe that you took your promote. I can't believe you took your disposition fee. I'm going to sue you because I want 2.1 on my equity, and somebody will sue you. And so if you have my initial scenario, just the LLCs, and somebody's not happy, hey man, there's direct liability. Everybody can sue. It's a very free flowing back and forth versus when you have this LP, the LP can sue, you're insulated. You've created a different legal structure. And yes, while you do have more responsibility to maybe the outside world, your liability to the insiders is less. And so there's disclosures, there's PPMs, the private placement memorandums, there's the offering memorandum, there's all these disclosures and statements about the deal that protect you as a sponsor from a disgruntled investor. And this is somebody who puts money into your deal. And again, I've seen it. It's not even that the deal goes sideways. If there's no money to be had, people are not as inclined to sue. But when there's a good return, but then the sponsor takes a promote or the sponsor takes a dispo fee, and somebody is just marginally unhappy, that's when they get really angry. And especially if you guys are syndicators and you're saying like, how do I broaden my network? How do I expand my circle? Well, the caveat to that is when you broaden your circle, you're by default meeting people that you have less of a relationship with, and you don't know them. You don't know if they're very litigious or if they're, just kind of a-holes to deal with. I don't know how to describe it, but you don't know them, right? You're literally saying, Ron, I've expanded the capital of my friends and family and people I know and trust. I'm going out to the broader market to, a friend of a friend, a friend of Chad's, a friend of Raphael that heard about the deal. You don't know him. So you need to protect yourself so that they don't sue you. And that's what that, I would say, the Reg D 506 offering does. You're putting out these disclosures internally to protect yourself from investors that, yes, you may have a pre-existing relationship. And, I know a lot of the people love doing the email, and they do like a 5-minute Zoom because their lawyer has said that will establish a pre-existing relationship for non-accredited investors. And I love it. I mean, it's all just kind of this song and dance. That's legal posturing anyway, but they do it right because it checks that box of saying, hey, we hopped on a Zoom call. Now we know each other. And now I'll offer you my next deal. And you can be one of my 35 non-accredited investors. But I just feel like it's all kind of a farce. It's meeting some lawyer's security and full disclosure, guys, I am not a securities attorney. I don't do the securities day in and day out. I'm a commercial real estate. We do nuts and bolts. We do PSAs. We do title and survey review. We do lender documents. We review a ton of leases. We draft leases. So what I do is I do securities raises for my clients, but with a securities attorney that we kind of partner with. So I guess that's my disclosure in the middle of our live interview, but that's my disclosure on this. I'm not a securities attorney. So if I misquote something, securities guys, please let me know. They love to reach out to me. Sometimes my other videos, I have guys saying, technically it's not this, technically. And I'm like, okay, well, I'm in a YouTube video. So
hey, that's part of content creation, man. You get comments and people saying stuff.
I love it. I love it. If you can't,
sure.
You're not big until you have haters. So.
No, and it's not even haters, they're just, again, and when you're doing something like this where it's live, I mean, again, you try to be as eloquent and fluent as possible, but there's certain things that maybe a word slips here and there, and it's just part of just interacting with someone on this level.
Sure.
And so, just it ends up happening. But one thing I wanted to go back a little bit on was related to, the way that you had mentioned accredited versus non-accredited. So when you're talking about these structures of how you structure syndications, obviously there's multiple different types. So could you kind of elaborate on that and then kind of distinguish what an accredited investor is, and then also, the ladder structure as well, or the ladder as well?
Yeah. So I think what you're referring to is, I'll go through accredited investor. I want to double check the standards right now. It's what, 200,000 annual income for the last 2 years with
like 2 or 3. Yeah.
Yeah.
It's like 2 or 3 years.
Two or three. And then 300,000 if you're married. married couple. And then if that will continue in expectation, or you can have the asset test, which is $1 million in assets, I think, excluding your primary as well. So there's all this tests, and it has been kind of interesting, for me in particular, because I've watched some of the testing evolve. So if anybody's been out there raising money for a while, it used to be all the accreditation was just self verification. It was like, I get a form and I just check, and then the sponsor could rely on that. And I think a couple of deals went sideways, and people said, well, I'm actually not accredited. The sponsor has a duty to try to verify that the investor actually is. So they've introduced third parties now, right? Your lawyer, your CPA can get involved, look at the tax returns, or your CPA can just check off on behalf of a taxpayer. And so those forms have really changed over the last couple of years. So it's interesting that, again, the law hasn't changed, but the interpretation and best practices have. So this is why, you have to kind of stay on top of what your securities lawyer says. Yeah, so that's accredited. And so 506B can have 35 non-accredited investors. And I think that's maybe where you're getting at. It's a little bit of nuance where 506C. And so again, what we're quoting is the sections of the US code that allow this type of investment. So it's regulation 506 sub paragraph B, like Bravo, or sub paragraph C. And that's what it's just kind of called in the industry, based on the requirements in that particular paragraph. So sometimes people get tripped up on that, but we're dealing with just really a very, very narrow slice of capital raising in the world, because again, 30,000 foot, real estate, commercial real estate is an alternative asset class. It is very small in terms of the traditional capital raising of the world, where you have the major players are equities and bonds, right? Those are the major fixed income and equity capital. Most capital raising is focused on equity for companies or for funds or for, CMBS. All those different products are fine, but they're financial products that are devoid of owning physical, tangible goods. And so I think it's important to understand, again, that context. Just because people raise a few $100 billion or, tens of billions in real estate, it's a drop in the bucket compared to all the other equity classes. So you're not going to get a priority. You're not going to get focus from most of the players, because real estate is an alternative asset class. I mean, you people look at commercial real estate, and maybe we've grown in the last couple of years just because of the low yields. But, with interest rates going up now, all the fixed income traders are going to leap back into life, and they're going to be raising tens of millions, hundreds of millions again for fixed income bond funds that are just going to trade. Forex is going to come back with all the global instability. You don't have this focus on alternative asset classes, like, literally it's like crypto, it's like tax conservation, solar credits, R&D credits. These things are just, they're drops in the bucket compared to the equity and bond market. What a $1 trillion bond market. Mm-hmm. So I just say that again for more 30,000 foot, so you guys understand. So we're dealing with we have a couple of ways to raise capital, but they're so small. They're like just a couple paragraphs. Reg D, Reg S is for foreign investors. So that's something a little bit interesting. If you raise and you market solely to foreign nationals, people who don't have U.S. Are not on U.S. soil and are not green card holders or U.S. citizens, you can file under Reg S, and you don't have to do a Reg D. You could do Reg D plus Reg S, but Reg S are for foreigners. Reg D is for this. You have Reg A, you have Reg CF, and some of these actually are coming into vogue for real estate capital now. It's kind of interesting. They raised some of the amounts, so that's why we've seen the rise of things like Fundrise, crowd funding on the internet. I don't know. I've seen a lot of different platforms but those are using different exceptions to raise from non-accredited investors, but they're filing under a different exception, exemption from registration. So again, kind of got off topic, and I apologize, but again, it's more that background context to 506B, 506C are the most common ways to raise capital to buy commercial real estate. They will be closed-end funds in the sense that I use that word to say, it's a specific asset. So you're not raising for a general asset type. That would be more of like an open-ended fund where you say like, hey, Raphael, I'm going to raise $50 million in equity. I'm going to be buying industrial properties near rail yards, and they're going to be located in Texas and Oklahoma. That's it. That's my criteria. But why should you give me your money? Because I'm Ron Rohde. I'm so great. This is the thesis. I haven't identified what I'm going to buy yet, but here's a list of 300 properties that we could acquire that meet our criteria. And I'll pick the best ones. You put your money in. And that's kind of next level beyond the close end, because while 506 B and C are really popular for just single asset or even a portfolio of assets, they're all identified. So I'm putting money into a specific asset. I'm explicitly saying, for example, I'm investing in 123 Main Street, or 123 Main Street plus 901 Elm and 511 Oak Street. Those three assets together, that's fine. That's still identified and it's closed. And the risk is a lot less to me as an investor because I've identified, I've maybe performed some level of property due diligence that I just have a higher level of trust, versus that next level after you get beyond 506 is just doing a $50 million, $100 million.
It's a fund.
A fund. Yeah. Well, I say that because I mean, like, technically it's kind of like a fund, but yeah, so those are the main ones. I think that, again, I've had people ask me like, hey, Ron, do I even need a securities attorney? I can download PPMs online. There's services that sell it for a couple $100. And I say, sure, you don't even need to download it. Just get the offering from somebody else. The core documents are really not what you're paying for. For better, for worse, you're paying the $15,000, right? That's kind of the market rate, I'd say now. You're paying the $15K for the changes that they make based on you as an investor, you as a GP, which you have different disclosures, and your property risks, which are different. So you download something for a multifamily deal in Houston. That's a 400 unit, 3-building property with, 92% occupancy. You're going to do Fannie debt. You've got this KP, blah, blah, blah. That is not identical to yours, because I think your deal, this hypothetical, the cheap client that comes to me says, well, I'm buying a 380 unit in Austin MSA, but it's at 88% occupancy. And so we need the different Fannie product to not hit, again, I'm not a lender, but I'm talking about, like, there's these different multifamily, like really granular products that you can qualify for if you maintain 90% occupancy. And then they say, oh, I'm not a KP. I'm going to pay somebody else to be a KP on my deal. I have other GPs that are raising funds for me as a GP. And so I tell them, like, look, these are differences. You're in different markets with different types of economic risk, different tenant profiles. Even if they're both Class A, they're not quite the same. They're different years of construction. They have different types of roofs on them. They have different, pool or no pool, or gym or no gym, or underground parking, right? A parking, like, those are the changes that you need to reflect as disclosures, because literally and again, I don't know if I'm being too granular, but it's the idea that if you don't disclose that you have a parking garage underneath your structure, and you don't disclose that there could be structural risks due to the crumbling of the concrete or the erosion of this, and that, we may lose money because of parking lot, an investor can sue you and saying, I didn't know that there was a parking structure. Oh my gosh, I never would have invested in this deal if he didn't tell me about this huge structural issue, whether it was known or unknown. It was just, it's not in the documents. And so that's what you're paying for, because they will look at all of your property level information and they will make changes based on the changes in your deal. And, we're not, yes, it takes an hour, it takes 2 hours for them to do all that process, but it's the expertise of knowing, okay, Ron, parking lot's a stupid example. That doesn't really matter. What I really care about is, the adjacent zoning use, or like there's a landfill less than 2 miles away. That's what I care about, disclosures based on, and I don't know what they are, but that's what you're paying for. And so, you for sure, you could copy anybody else's PPM and change the names and change the addresses, but you're paying the attorney for the changes. So I just caution people is, if you're raising $3 million, $5 million, it's just so silly to save 15K on that type of raise. And if you're not making enough profit that you say your DD costs are too thin, you can't afford another 20K, for legal, I would say, find another deal, find something with more meat on the bone, because you're overpaying, or you're under raising equity, because the legal ramifications, again, personal liability, they're going to sue you for all the gain that you made, all the equity that you put into the deal. That becomes ground zero for these securities plaintiffs lawyers that I used to be in Miami. It was a huge practice in Miami of plaintiffs securities attorneys that they just sue all these GPs for failure to disclose, right? You don't even need to lose money, but it's like, you didn't disclose this, so I'm going to sue you, and you have assets. But yeah, I mean, that's kind of my cautionary tale.
Oh, for sure. And I think it's like you said, that's a very wise thing to say, because you're right. If you're raising capital for these larger deals, I mean, $15,000 is nothing compared to what the cost could be if something were to occur that is outside what you expected. And really, you pay someone for their expertise and all the scenarios of things that could potentially go wrong, because if securities attorneys have been in the business for 30 years, they've seen a lot of things. So they understand what could potentially go wrong, and then hopefully help you mitigate those risks on your offering. So just to provide a quick overview, just so that we understand for those who are listening, you mentioned the 506B, that allows you to allow a certain amount of unaccredited or non-accredited investors in the deal. And typically those investors, you have to have some form of, contact beforehand. Is that correct?
Yeah, you need to have a pre-existing relationship, which they've said is, just kind of a Zoom call outside of the capital raise context. I mean, there's a couple more too. I'll just say, part of the 506 rules is basically you are exempt and you will qualify as a safe harbor. So that's really proving that you don't need to register this security offering if you follow the rules under 506B. That's the whole thing with these types of registrations, is that you're exempt. You're in a safe harbor for registration, because the failure to register penalties, again, are very, very strict from the SEC. And so you want to make sure you comply with the things. There are restrictions like on general solicitation, right? So you can't do Instagram ads for a Reg D offering. And I think that you can talk to 5 different securities attorneys who will all give you 5 different levels of public solicitation, right? So, and I agree, it's hard, because these days people will post on like Facebook on a comment and be like, oh, I'm raising money for my deal, contact me. Is that a public solicitation? I mean, yes and no. On one sense, it's public. Maybe it's made out to the world, but it was maybe directed. I could be replying in a direct comment to you, and they're going to argue, well, it's not really meant for the public. It's not intended to have a broad reach, but the consequences. And I can't control if I send an email to Chad and he forwards it to 100 people. I didn't intend for it to be broadly public like that. So just be aware of that, because it's a question that you'll need to come up with your marketing plan of, how do I raise this capital? How do I find the deal exposure so that if somebody wants to invest, and you're going to have to balance that internally and talk with your securities attorney about what is it that we plan to do to get the exposure out there for this deal, so that we can raise enough money. And So the securities attorneys that I know, like they'll work with you on all of your marketing as well. They'll review your language, your disclaimers, who you plan to send this to, how you plan to distribute it, whether it's, I think these days, again, it's mostly emails, right? Email blasts, and Zoom webinars, maybe in person. People, I think those are always okay, like to hold a seminar or to chat people up directly. But other than that, right, you don't have your traditional marketing to say, you can't just post on YouTube, for example, like only about a deal. That
Yeah,
to me would be public solicitation. You can't buy Instagram ads, you can't buy Facebook ads, you can't buy Google ads to advertise. So
sure.
there's a line between advertising education or brokerage services versus hey, I've got a deal, and it really has to
Absolutely.
do ultimately with like, how are you, what's the lead, how are you hooking people? Is it based on a return? Do you use the words like invest? If you do, you're probably going to get black flagged. But if you say like, hey, I'm Raphael, then that's okay.
Yeah, no, for sure. And that's important designation, because I know a lot of people, that are getting into the content creation space, and you have to be cognizant about how you're portraying yourself for a variety of different reasons. But in particular, if you're going to be eventually trying to raise money for deals, like you can't directly solicit someone for a particular deal on your YouTube video. So you just got to be very careful with that. So I wanted to give some flexibility for people on the call as well to ask any questions. So what I'll go ahead and do is I will open it up to questions. So if you guys are in the Zoom call, feel free to type away in the chat box. And if you guys are on LinkedIn, I will be checking as well for comments. So feel free to type away there. So I'll look at the Zoom call real quick. It looks like we do have one question. So Stephen was asking, what's a good way to screen people as you're, going through the process of determining whether or not they're a good candidate for for them to invest in a property?
Yeah. I think you got to talk with that with your GP team. And you do kind of internally rank people. I know if it gets close to the deal and you're not quite there, you'll take more risk than you normally would if you're oversubscribed, right? You get to pick and choose. I would say the good way is really just to try to talk to them. The best investors are people that truly understand and truly can stomach the risk, right? You want the really rich person that's doing this purely as lunch money, purely as like a bet on roulette at Vegas. And when they say, I don't need this money, I can lose it, it's not going to cause me heartburn. That's a good person if you believe them when they say that. So I would say that, understanding and really comprehending the disclosures, if they have a lawyer look at their documents and then they still want to move forward, I think that's a good sign. I don't know. I review a fair amount of like LP stuff for other people. And when they still invest, I think that's a good sign of commitment to the GP, because it really kind of doubles them down. It makes them that much more trusting of the GP team, which you want trust from your investors. That's a high level. Obviously experience, going through full cycle, going through a long deal, is great. If you can find an LP that's done that. Other than that, it's a balance, because I'll be, for me personally, I talk to people that want to invest. And if you ask too many questions, I get annoyed. And I don't say if they're too many questions, but do you know what I mean? There are questions that I kind of feel like you should know, as opposed to
There's a certain level of research you do ahead of time, whereas and that's in any professional setting where you would expect someone to have a little bit of understanding of what's going on, but again, it just depends on the individual.
Yeah.
So
Like I want them to ask good questions, but just a couple. Like, give
mhm,
me your top 3, but
mhm,
don't ask me what the market vacancy is in Tarrant County, right? In Fort Worth. Don't ask me what the market vacancy is, because it's like 1%, it's 2%, it's 2% everywhere. Like what's the point? What are you really going to
mhm.
gather from that? And what are you going to tell me? Versus somebody saying, what's your optimal repositioning? You have your plan A, but on plan B scenario, what would be your trigger for you to decide when you do A or B? I like that question because it's really good. Like, that's great, Ron. You've got your plan A, you've got your plan B. But
Strategy. It's more strategy than
and
it
what's
is.
the trigger? And
Yeah.
is that trigger like very clear? Is it time based? Is it market based? Because that to me will determine a lot of risk. And it's a good question, because if I was an LP and my sponsor or the guy in control, if he doesn't really have that clear, he doesn't really know how to pull the trigger confidently himself. So, I'm always in favor of decisive action, right? Like, choose a lane, but put your signal on and move over. Whatever you do, don't straddle, because straddling, you just bleed to death. So I would respect, or I would really like that question of what's your trigger, and how quickly can you decide? So.
Yeah, a good call. And obviously, if they're accredited, for example, you're going to have some forms to provide them to verify, in fact, that they do have the requisite income and or the assets to be able to invest in an opportunity. So that's part of the screening, I'm sure. But like you said, I imagine part of it is just getting a feel for them and having a conversation. I mean, most people, if they're going to invest, whatever they're going to invest, 50,000, 25,000, 100,000, they're going to probably want to have a conversation with you first before they do that. So just take advantage of that
Maybe
conversation.
25K. I mean,
well, I know I'm throwing out a number. It could be whatever your threshold is, like 100 grand. I mean, if I was gonna invest 50,000 with someone, I would probably want to have a conversation with them, right? At least my logic would be that, but who knows?
There's another one too. I think Brent
Yeah.
said, can you structure your LLC to cut down on lawsuits? So definitely, I think that asset protection at the individual or GP or company level is different than at the SPE, because at the property level, operational, you're going to have your SPE, and that's, again, kind of like people on the ground, the slip and fall accidents, the vendor who gets hurt, the contractor who breaks his neck, the tenant who gets hurt on the property. That's one thing, and that structure is pretty much set. You can't do a whole lot because you're already pretty well protected. The next level is, how do I protect Raphael as an individual, and how do I protect Raphael's company as a GP in relation to an individual project? Because now their position is opposed to the project itself, like lawsuits from the project against, I don't say call management, but sponsoring group. If you have other GPs, or outside liability from other parties, not just your internal product. So yeah, we can talk a little bit about that, but that's really a separate question. It's certainly not related to the syndication side, because that stuff is very well protected from the operational dirt level, I call it. So.
Yeah. And there's a question for James. To the extent that you've seen or had your own success in multifamily deals, has it all been agency debt, or are there other capital sources out there?
Oh, for sure. So, again, full disclosure, I haven't done multifamily. I haven't been a sponsor. I'm familiar with it. Check out my YouTube. I do a great video with Ethan, who is a key principal, and he's like one of these KPs for hire. It's kind of cool, but he just keeps money liquid, and then he's got his whatever Fannie Mae guarantor card or whatever you call it. Yeah, I would check out that video on YouTube, Ronald Rohde Law. But there are other capital sources. Absolutely. You can definitely still go to regional banks, credit unions. They still have pretty good rates. Their loan amounts are going to be smaller, right? They can't lend as much, but if you have a smaller town deal, a smaller purchase price and a smaller market, credit unions, I've seen them give really good rates even now. I mean, I had a client that just locked in in the 4s, and I'm over here closing a deal at 5.4 on industrial in DFW. I'm like, holy cow. But that's the credit union, they're lending deposits, so they're still making a spread between 1% and 4.25%. So yeah, there's definitely other sources. I would say that, you just need to reach out to them and see what their unique advantage is. I've been involved in a lot. So again, sidebar, I used to do EB5 financing. So I'm Chinese. I speak Mandarin Chinese. My mom's from Taiwan. And so I did a lot of EB5. And so EB5, which if you're not familiar, is like investment immigration. Foreign nationals can invest money into the US. They get a green card. We create some jobs, blah, blah, blah. It was used a lot, billions of dollars was coming in for real estate financing. And so that would be a perfect example of people were just kicking out bank debt because they didn't need it. They could raise all their money from EB5. And that is something that it kind of comes in vogue. It becomes popular, and then it fades away. But that's not to say you can't figure out what the next capital source is going to be. Israeli bonds for a while were really hot. I'm not sure if you're familiar, but like you were able to put up collateral and sell bonds on the Israeli bond market for a while. So yeah, there's always going to be other sources other than banks, credit unions, private lenders, family office, I think is good partners. Life cos. Life cos are great too, because they can lend on the full capital stack. So they can give you debt and give you mezz and even come in equity, and then they'll look at a blended return, but they're willing to like take the full risk of the full cap stack. And again, these are pretty high level. So to the extent Raphael is talking about beginners, you're going to have to have a pretty solid track record to go to life cos. But that's not to say you can't target that eventually.
Absolutely. Very nice.
I think Steven has a question.
Yeah.
I saw that.
He didn't type away. I didn't see the question.
He has his hand raised on my little thing.
Oh, he does? Oh, okay. Did you want to ask a question, Steven?
That's okay. Yeah, I asked my question, but I'd love to talk offline. Thanks so much, Ron and Raphael, for doing such a great job on this webinar. Fantastic.
Oh, absolutely, man. Glad you were able to make it, for sure.
Yeah.
I think we have enough time for, let's say, one more question. I want to make sure we keep to the hour. Brian made a comment that I thought was kind of funny. He said, my corporations professor would always say shareholders are walking liabilities. So always
yeah, keep as few as possible, or I do think, again, my best advice too is, capital is really easy. Capital is fungible. It's highly liquid, and everybody's looking for yield or looking for hedging, inflation hedging. But build up a little bit of a track record. If you have a good deal, capital will come. That's just guaranteed. People really kind of focus on the money raising, but yes, you can set up the structure. But if you have a good deal, you can raise the money. And if you're having trouble getting the money, it's maybe not of a good as a deal as you think. But that's true for debt. That's true for equity. The other caveat to that would be time. I've seen really good deals raise a lot of money, but then they're a little bit short and they just can't expose the deal to enough people in time to close. And so what happens is they come up to an LP and it's a week before, 2 weeks before closing. And they're like, hey, we just need another 300K. We need another 400. The guy knows if you're talking to me at this level, this stage, you can juice it for more return and you can renegotiate the terms, the return, because they need the money to close. And so that's just something to consider is, give up some point. It's better to close a deal and save it for all your other investors and make that investor a lot of money than to I don't know, not close.
Lose an opportunity for sure. All right. So Clarence had one question. We'll go ahead and wrap up after. It said, if you have a key principal, KP, who signs off on a loan, what liability, if any, do the rest of the general partners, GPs, have?
Yeah, I mean, I think they're still liable to the extent it's non-recourse. The key principal is really just kind of like extra. I kind of view them as more of a guarantor, like on a loan. But if you are going to be a responsible party, you don't have to be the key principal level, but you're still involved. You can still sign off. Co-GPs are different if they're lower down, and I hate to, it's kind of just your specific deal, but I've seen them structure it differently. You can drop them off if the co-GPs are small enough. They just don't exist to the lender.
Mm-hmm.
So
Great advice.
Clarence has a huge thing on LinkedIn. So
He does. He's awesome.
Check him out as an influencer.
Absolutely. I would highly recommend that as well. He does a lot on LinkedIn. So you guys should definitely be following Clarence. Well, great. Ron, greatly appreciate your time. I know you're super busy. It's always great to connect. If someone wanted to learn more about what you do, I would highly encourage you guys to subscribe to this YouTube channel. Always provides phenomenal information. He's also been on a ton of podcasts, so check out those as well. But if someone want to learn more about you, how can they best do so?
Yeah, I would say, just check out our website or my email is Ron at Ronald Rohde Law. That's RON at RONALD law, LAW.com. Just shoot me an email. I'm happy to chat. I love commercial real estate. I just talk about it all the time. If you're my wife, you probably want to shoot me in the face, but I'm doing a video right now as well, like how to balance commercial real estate and your life, because it's something that I was just thinking like, this is a really big issue, but I love talking about it. So people shoot me emails, non-legal questions, industrial market questions, happy to chat. And that's the best way.
Of course. And we'll include all that stuff in the description as well. So we're going to be recording this, it's going to be on the YouTube channel as well. So if you guys watch this on YouTube, it'll be in the description below. And if you guys are listening to this in a podcast format, we broadcast it live on Apple Podcasts, Spotify, etc. It'll be in the description as well. So Ron, thanks so much for stopping by, and thank you all for stopping by as well. We'll see you all next time.